Right now, as we speak on Thursday, January 29, 2026, SoFi Technologies is trading at $24.58, marking a sharp intraday drop of 88 cents, or roughly 3.45% since the opening bell. If you've been watching the tape this morning, you saw it briefly test a high of $25.79 before the momentum stalled and it slid toward a daily low of $24.57. This kind of volatility isn't just noise, it's a high-stakes tug-of-war happening exactly 24 hours before the company is set to release its fourth quarter results for 2025. While the market narrative suggests a standard pre-earnings shakeout, the reality is far more complex. Most investors are looking at the headline growth and waiting for a beat, but they are missing the subtle institutional rotation that is currently placing a heavy lid on the price action. While retail traders on platforms like Reddit and X are bracing for a massive squeeze or a parabolic move to $30, several prominent hedge funds have actually been trimming their positions throughout the morning, effectively selling into the retail hype. The immediate expectation for SoFi is that it will continue its streak of profitability with a consensus earnings estimate of 12 cents per share. This sounds great on paper, especially considering the company was deep in the red not that long ago. However, the market is no longer rewarding just being profitable. The new reality is that the valuation has reached a point where SoFi is being priced more like a high-growth software company than a bank, with a price-to-earnings ratio hovering around 46x. Compare that to the traditional banking sector, where multiples usually sit in the low teens, and you start to see why there is such a massive disconnect between the bulls and the bears. If you speak to most retail bulls, they will tell you that SoFi is the Amazon of finance or the AWS of fintech through its Galileo and Technisys platforms. They see a world where SoFi doesn't just hold deposits, but powers the entire digital banking infrastructure for its competitors. But the contrarian take, the one the big money is betting on right now, is that SoFi's lending segment is still its primary engine, and that engine is facing increasing pressure from a shifting interest rate environment and rising credit risks. Looking at the recent trading volume, we are seeing a significant uptick in block trades, which typically signals institutional movement. Just today, over 29 million shares have changed hands, a figure that is pacing well above the 30-day average. What's interesting is that while the buy-the-dip crowd is active at these $24 levels, the short interest remains stubbornly high at nearly 117 million shares, or about 9.4% of the float. This creates a fascinating psychological setup. Short sellers are betting that the stock has run too far too fast. It's up about 60% over the past year, while long-term holders are convinced that an S&P 500 inclusion announcement is the next logical step. This rumor of index inclusion has been a major tailwind, but it also creates a dangerous priced-for-perfection scenario. If the earnings report tomorrow morning shows even a slight deceleration in member growth or a tightening of net interest margins, those same shorts will use it as a catalyst to drive the price back toward the $20 support level. To understand how we got here, we have to look at what SoFi actually does versus what the market thinks it does. On the surface, it's a digital bank that provides student loans, personal loans, and mortgages. But underneath the hood, the business model has shifted toward a capital-light, high-margin financial services productivity loop. They want to acquire a customer with a low-cost product, like a checking account or a credit card, and then cross-sell them into high-value loans. This reduces their customer acquisition cost and creates a sticky ecosystem. Their technology platform, driven by Galileo, provides the plumbing for other fintech firms, allowing them to issue cards and process payments. This segment is the one that provides the growth premium in the stock price. However, in previous reports, this tech segment hasn't always grown as fast as the lending side, which creates a point of frustration for investors who want to see SoFi move away from its identity as a traditional lender. The emotional temperature on social media is currently at a boiling point. If you scroll through the dedicated SoFi communities, you'll find a mix of intense loyalty and rising anxiety. There is a palpable sense of frustration regarding perceived market manipulation by large hedge funds. Retail investors often point to the high volume of off-exchange or dark pool trading, which has accounted for over 36% of recent volume, as evidence that the price is artificially suppressed. On the other hand, there's a loud contingent of diamond hand believers who are convinced that CEO Anthony Noto's aggressive insider buying in previous quarters is the ultimate signal of long-term value. There's a deep psychological investment here. Many people didn't just buy a stock, they bought into a vision of a modern financial institution that isn't clunky or predatory. When the price drops nearly $1 in a single morning like it has today, the reaction isn't just financial, it's personal for a lot of these traders. Institutional activity tells a slightly different story than the retail enthusiasm. Recent 13F fillings show a mixed bag. For instance, Jewel Financial Limited recently trimmed its stake by over 54%, and we've seen net insider selling of about $4.3 million in the last 3 months. This doesn't necessarily mean the ship is sinking, but it does suggest that the people closest to the numbers are taking some chips off the table at these multi-year highs. When insiders sell, retail often panics, but it's important to distinguish between selling for liquidity and selling because the business is failing. In SoFi's case, the sales have been relatively small compared to total holdings, but they happen at a time when the stock is struggling to break through the heavy resistance at the $26 to $27 range. So what are the traders actually watching as we head into tomorrow? The most critical metric won't just be the EPS beat, it will be the guidance for the rest of 2026. If the company suggests that the lending reset is taking longer than expected, or that the student loan refinancing boom, a core part of their legacy, is cooling due to new government policies or economic shifts, the current valuation will be very hard to defend. The reality is that SoFi is currently navigating a period where it must prove it can grow its non-lending revenue faster than its lending revenue. If it can't do that, it will eventually be valued like a bank, which would imply a significant haircut from today's prices. But if the tech platform surprises to the upside, we could see a massive short covering rally that pushes the stock toward the $30 mark. There's also the macroeconomic pressure to consider. The recent Fed actions have been a double-edged sword for fintech. While lower rates generally help the tech side and make borrowing more attractive, they also compress the margins that banks make on the money they hold. SoFi has been very clever about using its bank charter to gather low-cost deposits, but that advantage narrows when the broader rate environment shifts. Traders are currently in a wait-and-see mode, which is why we're seeing this preemptive selling today. The disbelief in the current price level is high, and the overconfidence from the bull camp is equally strong. This is a classic setup for a volatile post-earnings reaction, where one side is going to be spectacularly wrong. Comment below how many shares of SoFi Technologies you currently hold and what your average cost basis is. Do you think the current price reflects the actual value of the Galileo platform, or is the market overestimating its growth potential? Looking ahead, there are 3 main scenarios for the stock. In the bullish scenario, the earnings beat is accompanied by a surprise announcement, perhaps a major new partnership for the technology platform or a definitive timeline for S&P 500 inclusion. This would likely trigger a squeeze of those 117 million short shares, potentially leading to a breakout above the $32 52-week high. In the bearish scenario, the results are just okay, and the market realizes that a 50x PE ratio is unsustainable for a company that still gets the majority of its profit from lending. This could result in a retreat to the $18 to $20 range, where many value-conscious investors are waiting to pounce. The third scenario is a period of long-term consolidation, where the stock stays range-bound as the fundamentals slowly catch up to the hype. In summary, the central tension for SoFi right now is the gap between its identity as a disruptive tech platform and the reality of its balance sheet as a bank. Today's drop to $24.58 shows that the market is nervous about this gap. While the expectations are set for another profitable quarter, the reality of institutional trimming and high short interest suggests that the path higher is not going to be a straight line. Investors are clearly torn between the fear of missing out on a future giant and the fear of being left holding the bag on an overvalued lender. Whatever happens tomorrow morning, the reaction will be a definitive statement on whether the AWS of fintech narrative is ready for its next leg up, or if it needs a serious reality check. The authority of the earnings report will either validate the retail hope or give the institutional bears the victory they've been betting on for months. Stay grounded in the data, watch the volumes, and remember that in this market, the narrative is often just the shadow cast by the actual numbers. Would you like me to look into the specific short interest data for its competitors like Affirm or Upstart to see how the broader sector is positioned?